Welcome back to FinScribble, everyone. Right now, something deeply weird is happening across the financial world. The stock market just crushed another record and hit a fresh all-time high. But if you look at retail investors, nobody is celebrating. In fact, people are genuinely terrified. The iconic Fear and Greed Index is flashing deep red in extreme fear territory at 25, creating a mind-bending psychological disconnect. Common sense tells you that record highs should bring overwhelming euphoria and reckless greed. Yet retail portfolios are frozen in cash, while headlines scream about impending doom. But here is the massive contrarian truth that Main Street constantly misses. Markets almost never peak when everyone is scared out of their minds. Today, we are going to unpack the wall of worry phenomenon and reveal 3 underlying structural signals proving why this specific market dynamic is far more bullish than you think. Let's dive in. To understand why fear at all-time highs is actually a fantastic sign, you need to grasp the famous financial phrase, bull markets climb a wall of worry. Picture a steep mountain where every single ledge represents a terrifying news event. Inflation fears, geopolitical tensions, rate hikes, or recession warnings. When investors are anxious, they stay cautious, hold extra cash, and hesitate to buy. This means the market isn't bloated with leverage or wild speculation. Instead of a fragile bubble pumped up by manic retail enthusiasm, prices are grinding higher because institutional capital quietly absorbs selling pressure, while everyday folks wait on the sidelines. Real market tops, like the dot-com bubble or 1929, happen when retail investors feel invincible and throw all caution to the wind. When everyone is already panicked, the bad news is already priced in, leaving immense sideline capital ready to push stocks higher. Now, let me break down signal number 1, the dramatic fear and greed divergence. Typically, when stock indices print new all-time highs, the fear and greed index climbs up into extreme greed, above 80. But right now, we are witnessing an extraordinary anomaly where prices are sitting at historical peaks, while sentiment sits crushed at 25 in extreme fear. This indicator measures momentum, put-call options ratios, market volatility, junk bond demand, and safe haven flows. When retail traders buy put options to hedge against imaginary crashes, they create massive forced buying by market makers who must remain delta neutral. Historically, whenever market peaks occur alongside extreme sentiment fear, forward 12-month returns have overwhelmingly leaned positive. Far from warning of an impending market collapse, this metric reveals that emotional retail investors are simply panicking out of winning positions, handing institutional buyers high-quality stocks at an incredible discount. Signal number 2 lies in the Chicago Board Options Exchange Volatility Index, widely known as the VIX. While retail headlines radiate sheer terror, the VIX is sitting quiet and subdued below 15. Why does this stark mismatch matter so much? Because the VIX measures the price institutional investors are paying for S&P 500 downside portfolio protection. If big hedge funds, pension funds, and asset managers were truly terrified of an impending crash, options premiums would skyrocket and send the VIX surging past 30. Instead, professional institutional capital is sitting completely calm, quietly holding equity positions without paying top dollar for downside insurance. Retail sentiment is hyperventilating over social media headlines, but institutional money is signaling smooth structural sailing under the surface. When retail screams panic while institutional VIX stays low, historical odds heavily favor the quiet, smart money every single time. Finally, let's examine signal number 3, the Relative Strength Index, or RSI. Many beginner investors mistakenly believe that any market reaching an all-time high must automatically be overbought and due for an immediate collapse. But technical analysis shows that true market tops, the explosive blow-off tops that trigger brutal bear markets, are accompanied by weekly RSI readings surging way above 80 into extreme parabolic territory. Right now, weekly RSI is sitting comfortably around 60, indicating steady, healthy momentum rather than exhaustion. This balanced technical posture shows that the current advance is supported by steady earnings growth and healthy market breadth across multiple sectors, not speculative fever. A market sitting at new highs with an RSI in the 60s isn't overheating. It is simply in a structural expansion cycle. Without parabolic RSI numbers, calling for an imminent market top right now is nothing more than pure guesswork. So, how should you navigate this psychological maze as an investor? First, stop viewing all-time highs as a dangerous ceiling. Historically, new highs are momentum signals that breed further new highs. Second, ignore headline chatter and keep your eye on structural indicators like the Fear and Greed Index, the VIX, and RSI. Maya learned that timing the market based on emotional panic is a losing game. Instead of fleeing to cash in fear, stick to your automated dollar-cost averaging plan and remain disciplined. When the crowd is screaming in terror while fundamental data signals calm expansion, that is your cue to stay grounded and let compound interest work its magic. Bull markets don't die of old age, and they certainly don't die on a wall of worry. If you found this breakdown valuable, subscribe to FinScribble, and tell me in the comments, are you buying or sitting in cash? As always, appreciate you hanging out today. See you in the next one.